Welcome to Questions to Ask Your Lender. My name is Tiffany Hayes with Tiffany Hayes Real Estate Group, and my goal is to help you make a smarter home buying decision. First question, what are the qualifying guidelines for this loan? If you've watched any of my other videos, I've referenced several different loan types. And for each one that you're interested in, you need to ask about the qualifying guidelines, the requirements that are related to your income, your employment, your assets, your liabilities, and your credit history. If there's a qualification for first-time homebuyer programs or VA loans, etc. You know, this is a very important question to ask because lenders run all kinds of math model checks, your debt to income ratio and the loan to value ratio, and all of these things have to work together in order to qualify you for a loan. And so you may be able to get away with more with one type of loan that you would with the other type of loan. So it really is important to be educated about loan types and ask questions about which one would give you the best financing option. What documents will I have to provide? So lenders require proof of income and assets, including bank statements. Normally they want at least 2 months worth of bank statements, at least 2 years worth of tax returns, and W-2 statements, paycheck stubs, all of the above. They need to verify your income. Now, if you are a self-employed person, if you've been self-employed for less than 2 years, you really need to talk to that lender about what can be done to qualify you for a loan. I am not a lending expert, but I know that if you have been self-employed for less than 2 years, there's some special stipulations that apply. And again, a lender would be best suited to answer that question. Now, more income documentation may be needed to show your down payment and your ability to pay closing costs. So they want to know everything. Just be prepared to open your books. Is there a prepayment penalty on this loan? That's so important because one of the trending things these days is to pay off your loan in a short amount of time. So even though you may have gotten a 30-year loan, maybe you want to pay it off in 20 years. Or maybe you take out a 15-year loan and want to pay it off in 7 years. So you need to know that if you plan to pay your loan off earlier or are considering that, is there a prepayment penalty for paying off the loan early? Some lenders will charge a penalty, but a lot of them don't. That's something that you can talk to your lender about. Some penalties apply only when you refinance or reduce the principal balance by more than a certain percentage. So you have to realize the lender is doing this loan not because they love you, but because they want to make money. And so if you're going to greatly reduce the amount of money that they can make on this loan, some of them say, okay, that's fine, no penalty. Others will say, I need this large chunk as a prepayment penalty. So that's something to check on with your lender. Will I have to pay private mortgage insurance, otherwise known as PMI? And this is also known as mortgage insurance premium with an FHA loan specifically. Typically, when your down payment amount is less than 20%, there will be private mortgage insurance attached to your loan. You have to talk to your lender about a payoff point and timeline when PMI can be removed. So, for example, if your monthly mortgage payment, including principal and interest, is $1,700 a month, but you put down less than 20% in down payment assistance, you might have an additional $125 in mortgage insurance premium attached on top of that mortgage payment. Now, depending on the type of loan you get, FHA, it may never go away. But with other types of loans, once you've reduced your loan amount to a certain balance, say paid off 20% at least of the balance, then it's likely that you can have that removed. Again, talk to your lender about that. What are the closing costs? That is huge because when you submit an application with your lender, it's so important to get back from them a loan estimate. Say you are looking at purchasing a $300,000 home. You can request a loan estimate from them that says, if I purchase a $300,000 home, what will be my interest rate? What will be my monthly mortgage payment? And most importantly, what would be the amount of money I have to bring to the closing table? And they can give you a printout of all of those calculations so that you can make an informed decision. So going back to closing costs, borrowers pay fees at closing for services provided by the lender and other parties, such as title companies. Lenders are required to provide a written estimate of these costs within 3 days of receiving the loan application. So that is something that you absolutely want to enforce so that you won't be caught off guard. What is the minimum down payment required for this loan? Again, different loan types, different down payment requirements. The size of your down payment is a personal decision. However, there are minimum down payment requirements for different loan types. The more you put down, the lower your monthly payment will be. So that's very important to note. Now, some people who don't have a lot saved up tend to want to dip into their 401k. That is such a personal decision, but not highly recommended. It's better as much as you can to save up for your down payment before you start your home search. However, not having a lot of down payment saved up does not disqualify you. There are other assistance programs to help you with the down payment. Some are completely free. Some you may have to pay back. Others are free, but they may come with a higher interest rate. So that's a question that you can ask your lender as well as your realtor to be creative with you to work through that down payment. But I can tell you that I have personally worked with a number of individuals who had very little down payment saved up, but they are in their new home at a comfortable mortgage payment. Do you offer down payment assistance? If so, how will that impact my interest rate? So again, some lenders work with special grant programs like the Texas State Affordable Housing Commission to provide loan and closing cost assistance to buyers. You just need to ask if you qualify. You know, it's good in that before you choose a lender, if you do feel like you may want to use a down payment assistance program, you need to find out which ones that lender is qualified to offer. There's one called Seth. There's one from TDAHC. There's one from TSHAC. Then there's others that work with county and city programs. So ask your lender which ones they are qualified to provide to you, because not all lenders are able to offer all down payment assistance programs. So it's a really important question if you think you're going to need that. Do you offer lender credits on this loan? What is a lender credit? A lender credit is money from your mortgage lender to help cover the mortgage-related closing costs associated with the purchase of your house. So your lender may offer you several $1,000s in credit to cover most of all of those costs. That credit is then applied to your mortgage. Let's say you need maybe $1,600 to help make the deal work, and you ask your lender to give you $1,600 in lender credit, meaning it's rolled into your loan, but they provide it up front to help you close. Just know that you will be paying for that in the form of interest. Nothing is free. Well, almost nothing. How long will it take the lender to process your loan application? Loan processing time has a lot to do with the type of loan you're applying for and how quickly you can get the requested documents submitted to the lender. Many lenders are now improving their processes and are closing loans in under 30 days. So you have to ask your lender for a realistic time frame for your selected loan type. So very important. I know that for some people choosing a renovation loan, the FHA 203K loan, it may be a 45-day closing period. For some buyers who choose to work with these big name brand banks and mortgage companies like a Wells Fargo or Bank of America or USAA, some of these larger mortgage industry lenders, sometimes their closing times can be a little bit lengthy when you compare them to other lenders. We're talking 45 days or maybe 60 days. Sometimes they tend to delay closings and you have to extend your closing date. I'm not saying that happens in every situation, but some of them have gotten some not so nice reputations. And let me tell you how important this is about the lender that you choose. If a certain lender has gained a reputation for delayed closings, real estate agents and professionals know about it. And so they could advise their seller, yes, this is a good offer. However, they're using X lender, and that lender is known for XYZ. Why don't you consider this other person's loan application instead? Because it's really important to sellers to close on time. So the lender that you choose is important. Yes, it's good to have a brand name lender, but it's also good to have a lender with a great reputation. Again, your realtor can help you navigate some of those waters. What is the interest rate on this mortgage? So you want to ask for the lender's loan estimate. Again, they call that an LE, loan estimate, which breaks down the interest rate and the fees. It'll include your annual percentage rate, or what's called the APR, which accounts for the interest rate, points, fees, and other charges that you will pay for a mortgage. So normally when the lender throws out at you, we'll get you in at a 3.75% interest rate. You can also ask them for the APR, or the annual percentage rate. That takes into account all the fees and charges, the points, the fees, and everything else that goes into setting up that mortgage for you. So don't just find out the interest rate, find out the APR as well, which will appear on the loan estimate. How many discount and origination points will I pay? Lenders may charge discount points, origination points, or both. Let's just talk about what a point is. 1 point is equal to 1% of the loan amount. For example, if you're going to get a $200,000 mortgage and pay 1 discount point, you'll pay a fee of $2,000 because that is 1% of $200,000. So what you're in essence doing is dividing the loan amount by 100 to calculate 1%. So to be clear, discount points reduce the interest rate. So for example, if your interest rate is 4% and you want to buy down your interest rate, then you'll ask how many, what they will charge in discount points, because it's just a way of prepaying that interest ahead of time. And the good news is discount points are tax deductible. Now, origination points are fees charged by the lender to cover the cost of originating the loan. Again, I continue to say this is not free. They're not doing it out of the goodness of their heart. So origination points is how much the lender is charging you to set up your loan. Can I buy down my interest rate? How much per point? Again, a point is 1% of the loan amount. Yes, you should be able to buy down your interest rate with most lenders. If you were quoted 4% and you want to buy it down to 3% so that your monthly mortgage payment will be lower, you can simply ask your lender for a rate sheet to determine the cost of buying down your interest rate. You can buy down your rate to reduce your monthly payment. 1 point costs 1% of your mortgage. If you're buying a $300,000 home, you want to reduce it, then you'll ask them for a rate sheet. If they say it's going to cost you 1 point, then you're looking at $3,000 in buy down. Again, dividing $300,000, your loan amount, by 100. When can I lock in the interest rate, and what will it cost me to do so? Interest rates might fluctuate between the time you actually apply for a mortgage and closing, so you gotta lock it in because you don't want any surprises, right? So to prevent getting a higher rate, you can lock the rate and even the points for a specified period. Talk to your lender about all of these details. Fees may apply, but not always. To keep tabs on rate movements, you can read Bank Rates Rate Trend Index. Can you show me the total payout of this loan over 15 versus 30 years? Now, this is the part where people tend to get sticker shock because nobody really actually looks at how much it's going to cost you to buy this house over the full term. So if you're going to buy a $300,000 home, you can have the lender show you what the payout would be at 15 years versus 30 years. Knowing your total purchase cost over differing time periods may influence the amount you want to spend on your home. The loan term impacts your monthly payments as well as the amount of interest you will pay over the duration of the loan. It may be helpful to view an amortization schedule, which is a table detailing how much of your mortgage payment will be applied to principal versus interest over time. So here's the thing for all of my number crunchers. If you take out a $300,000 mortgage over 30 years, you may have a slightly higher interest rate, but your monthly payments will be lower. If you take out a $300,000 mortgage over 15 years, your interest rate could be a little bit lower, but your monthly payments would be higher. Now, regardless of which one you choose, the total payout is going to show you how much you have actually paid over the lifetime of that loan, your principal and your interest. And a lot of times you'll find out that for that same $300,000 loan you took out with the bank, if you draw your repayment period out for 30 years, you probably could have purchased 2.5 homes for that amount. I mean, I'm not doing the calculations in front of me right now, but over 30 years, you could pay out as much as $750,000, all things considered, for a $300,000 home. That may not mean much to some people, and to others it may mean a great deal, but knowing how much it's really going to cost you to buy that home is something that you should consider. What might delay approval for my loan? What could delay it? A job change. Don't do it. An increase or decrease in salary. Well, you definitely don't want a decrease. A new debt. Don't take out any new debt. A change in your credit history. If it's negative, that's not a good thing. Or a change in marital status could delay your loan approval. Let me say this. If you are still legally married, it matters. It doesn't matter if you've been separated for 5 years or 20 years. In Texas, if you are still legally married, then your spouse, Texas is a common law state. So it matters that you still have a spouse. So you want to take care of those divorce issues before you try to buy a home if you're going to buy it on your own. The best way to avoid delay is to put your financial life in a holding pattern until you reach the closing table. Now, one thing that I want to share with you that's going to elaborate a little bit on what you should and should not do when you are in process of applying for a mortgage for a loan until the time that you close on that loan. It is affectionately called the 10 Commandments of Buying a Home. The 10 Commandments of Buying a Home. I'm actually going to read through each of these because it's kind of cute, and it is also downloadable on my website. The 10 Commandments of Buying a Home. Thou shalt not change jobs, become self-employed, or quit your job. Again, this is during the period of your application through the time that you close on that home. Number 2, thou shalt not buy a car, truck, or a van, or you may be living in it. You don't want to make any large purchases while you are in process of buying a home. Commandment number 3, thou shalt not use credit cards excessively or let current accounts fall behind. Number 4, thou shalt not spend money you have set aside for closing. Number 5, thou shalt not omit debts or liabilities from your loan application. At the closing table, you are going to sign so much paperwork that is so repetitive because all of it is saying you did not provide false information. If you did, there's penalties for it. So just tell the truth, the whole truth, and nothing but the truth all the way through the application process, through closing. All right. Number 6, thou shalt not buy furniture. Again, no large purchases. Number 7, thou shalt not originate any inquiries into your credit. You shouldn't be letting anyone else pull your credit during the time that you're buying a home. Number 8, thou shalt not make large deposits without checking with your loan officer. What's the big deal if you're putting money in your account? Here's the big deal. There's a huge movement in the lending industry to combat fraud and money under the table. So they have to track and source every dime that you are using to take out this loan. So if you make a $500 deposit into your checking account, where did that come from? Did it come from your normal ways of receiving money from your job or something of that nature? They're going to have to source it. So it's just best, don't make any large deposits. I mean, if someone is giving you gift money to help towards your closing costs, that's a different matter. But they're going to have to provide a letter and probably their bank account statement saying that it left their account and landed in yours. Just know that any money that lands in your account is going to have to be sourced if it looks, I don't want to say suspicious, but if it's out of the ordinary. Number 9, thou shalt not change bank accounts or move large sums of money around. And commandment number 10, thou shalt not co-sign on a loan for anyone. It all goes back to leaving your financial status in a holding pattern until you make that mortgage purchase. Well, this has been an overview of the types of questions that you need to ask your lender. I hope that you have found it beneficial. I hope that it will help you make a smarter home buying decision. Feel free to call me at 972-591-1137 for any questions that you have.